Good evening. I'm Dr. Joel Silverfield, President of the Hillsborough County Medical Association. We are excited tonight to have our friends, Physicians Wealth Management, giving us another webinar. The ones that they have done before have been very widely and very pleasantly received. I think all of us as physicians, we work so hard that we sometimes get lost down in the weeds. We figure just by mere fact of working hard that our future will be assured. As we watch the stock market crash today, I realized that I'm going to have to work 5 more years now. But most of you younger doctors who are starting up, you can't ever have too much in savings. And for us older doctors, you start looking at retirement down the road, you need to have people like Physicians Wealth Management on your side. Physicians Wealth Management, it's a Jensen Anderson company. They're physicians wealth planners. They're financial planners that have dedicated to serving physicians in our area for more than 30 years. They've been good friends of the HCMA for the past several years. And again, we're honored and excited to have them tonight. Michael Jensen is a certified financial planner and a certified family business specialist. In addition, he is an adjunct professor at the USF Morsani School of Medicine and has helped a lot of young doctors see their future more brightly. Jeffrey Anderson has been with us on several of these seminars. He also is a certified financial planner, and we feel very fortunate to have the both of them with us tonight. Thank you very much, gentlemen.
Thank you.
Thank you, Doctor. And thank you, everyone in attendance. There are a couple of things I'd like to say before we start. We had to consolidate certain things to fit into the Zoom time span. So we might have to go a little quicker this evening, okay? But just if we start going too quick, just let us know, okay? So that's one thing. The other thing I just want to repeat is that I know it's harder to do with Zoom, but normally when we're teaching in a conference and teaching classes, Jeff and I use a conversational method. I know you heard us say the same thing last week. I want to say right now, please ask questions because we learn, you learn, we all learn from asking questions and hearing the answers. So please do that. I know it's a little bit more difficult with Zoom than if we were in person the way that we would all like to be. Okay, so those two things, conventional terms. I'd like to start with just, what is an IRA? Jeff, you want me to start right into that now?
Yeah, let me just say one thing. Where we're starting, we're actually going to be going, if you're following along in the book, remember, we don't go over every page in the book. We're going to be in session 1, chapter 4, which is retirement income sources. And we're going to start covering IRAs. If you have any questions, you can use the chat feature, and I'll be checking the chat feature to answer any questions that may come up through the evening. Okay, so, all right, Mike, we can go.
Okay. Now, an IRA, what are IRAs? IRAs are just tax-favored savings investment plans that help all of us accumulate dollars for retirement, okay? An IRA is not, okay? An IRA is not a particular investment. An IRA is just a registration that provides all of us with federal income tax benefits, okay? So it's just a registration, okay? Now, who uses an IRA? You're going to use it if you're not participating in an employer-sponsored plan at work. You would use an IRA. If you're already making maximum contributions to your qualified plans, which I hope everyone is doing, by the way, you may use an IRA. Or you could have a spouse who wants to save, but she doesn't or he doesn't have earned income. That's a way for you to put more money away. Because you're transferring, another time would be when you're transferring money from one employer to another, or one employer to when you go to retire into your private accounts. That's basically what it is. IRAs, as you're going to see with qualified money, is a way for us to take advantage of the tax laws and do good for ourselves. Okay? In other words, what the heck is an IRA? Okay, an IRA, as I said, is tax-favored savings, accumulate dollars for retirement, not an account. Okay, there's 2 basic kinds of IRAs, everyone. There's one that is the traditional IRA. Traditional IRA means you get an upfront ordinary income tax deduction, but at withdrawal, everything is taxed. That's a traditional IRA. A Roth IRA is no deductions when you make these deposits into these accounts. But when the money comes out, the money all comes out tax-free. Jeff, can I ask you a question? Do we like Roths or not?
Yes, we do. We like tax-free income, that's for sure.
Yes, we love that. Okay. And Jeff, you can take that. Go ahead.
Okay. So two different types of IRAs, traditional and Roth. Mike had talked about the taxation. We're going to talk about whether we can do each one of these or not. A traditional IRA, if you don't, you can do up to $6,000 or $7,000 if you're over age 50. So can I make a deductible contribution to a traditional IRA? If I don't have a plan at work, then there's no income test. If I have a plan at work, there's an income test. That income test is for married filing jointly under 198, you can do a full deduction. In between 198 and 208, it's partial. And anything over 208, married filing jointly, you cannot deduct your contributions to traditional IRA. And for single filers, the number is where it is there. It's 105 for single filers. Okay, so if I have a plan at work, I have to pass the income test. If I pass the income test, I can make a deductible contribution to my IRA, $6,000 under age 50 and $7,000 to the catch-up provision if I'm over age 50. So that money goes into an IRA account, right? And I make my contributions and I take a tax deduction every year I do that, right? So let's say over my lifetime, I've put in $500,000 and at 59 and a half, it's worth $1 million. I can take, when I take that $1 million out, all of the money coming out at that point is taxable to me. All right. So the money I put in, I took a deduction plus the growth, all that money is taxable to me. I can take it out without penalty at 59 and a half. If I take it out before 59 and a half, it's ordinary income plus a 10% penalty. But after 59 and a half, it's just ordinary income. At age 72, they force you to start taking money out, what's called an RMD. And we'll talk about that in the distribution chapter. All right. So if I qualify, if I don't have a plan at work, no income test. Plan at work, there's an income test. And that allows me to deduct or not deduct. And then the money grows tax deferred. Everything's taxable on the way out. And at 72, they force me to start taking RMDs. So what's a Roth? How's that operate? Well, the Roth, it doesn't matter if you have a plan at work. It's the income test only. And less than 198 married filing jointly, you can make a Roth contribution. And a single file, less than 125, you can do a full contribution. Once again, $6,000, $7,000 if you're over age 59 and a half. Here's the big difference here with the Roth. I don't get a deduction for the Roth, right? So I don't take any deduction off my income like the traditional. In my example, I put in $500,000 over my lifetime. It grew to $1 million. That whole $1 million at 59 and a half comes to me tax-free. So my contributions, I didn't take a deduction, so I always can take those out. In fact, I can always take those out before 59 and a half if I need money that's accessible. The growth is all tax-free. So this is really nice, particularly, probably everyone on this call has a nice long time horizon, which means you're not going to need the money for a period of time. So all that money is tax-free growth. It's a great deal, a great asset to leave to somebody because your estate doesn't have to pay taxes on the Roth. And also there's no required minimum distribution on the Roth because they are not getting any other tax revenue from this. Therefore, they allow you to keep it in there forever.
Jeff, may I add something? I'm sorry for the interruption.
No, of course.
One of the important things about these are called qualified plans. One of the very important things for physicians, especially, is that the money inside these plans are all asset protected. It's treated like life insurance or annuities. It's asset protected. The money you accumulate in there, when you get sued, and you will be sued if you haven't been already, the money is asset protected. Jeff, I'm sorry for the interruption.
No problem. No problem. So a lot of physicians make too much money to do the Roth. So there's something called a backdoor Roth that's very common for physicians. And what that is, it's a little bit complicated. I make a non-deductible contribution to my traditional IRA, right? So I could do $6,000 or $7,000 if I'm over age 50. And this is assuming that you have no other IRAs. If you've got other traditional IRAs, there could be a problem. This is assuming I only have my 401k and no other traditional IRAs. I could do a backdoor. What that means is that I make a non-deductible contribution, $6,000 goes into my an IRA, traditional IRA, but I don't take the deduction. And what I'm able to do is convert that over to a Roth, and I bypass the income test. Right. So if I've maxed out my 401k and I'm looking for an additional place to put money, and I've got no other traditional IRAs, then I can do that backdoor Roth. If I've got a traditional IRA, then you need to talk to somebody because of something called the pro rata rule, and it gets a little funky on whether you can do it or not. Okay. So that's the backdoor. Now, you may have also heard of Roth Conversions. What is that? Well, what a Roth conversion is, let's say I do have money in my, let's say I've got $1 million IRA, traditional, but I want to make it a Roth. How can I do that? Well, you could convert the whole $1 million, which we don't recommend because you'd have to pay tax on it. Whatever you convert, you have to pay tax in that year, and you have to have that tax money in your bank account to pay that tax because you don't want to withhold the tax out of the converted amount. That's very important. All right. Maybe I only want to do that year. Maybe I want to burn up some of my marginal tax bracket. I'm in a low bracket for some reason. I want to convert a couple $100,000. Or if the market has corrected and maybe the market's down 30%, we had a big correction, you can actually convert the individual securities that you own over while it's low. And then when it bounces back, you've now converted all that to tax-free growth. All right. So Roth conversions, there's no income test there. You can convert no matter how much money you make. And that's making your traditional into a Roth, and you pay the tax on it now because maybe you think tax rates might go up in the future, which could likely happen. And now you converted that money over now to get all tax-free growth for the rest of your life. That's a Roth conversion.
Be very, very careful with them. Make sure you're working with a professional that knows what she or he is doing on this.
Yep.
Get started, kid.
Okay. Investment accounts. We're talking about retirement accounts, non-qualified investment accounts, your individual brokerage accounts or your trust accounts or your joint tenants by the entirety investment accounts. Those are sources of income at retirement. Employment income. Well, sometimes people work part-time, right, Mike?
Yes, especially physicians. And as we said last week, physicians sort of work and don't work, and work and don't work. They phase in and out. So you have to be careful with that.
So what I'm going to do is I'm going to jump in. We're going to use a different Social Security presentation tonight. So I'm going to pull that up real quick here, and we'll jump into Social Security. Okay. So we'll start off with, in life, would you rather be early or delayed or pay a penalty or get a bonus? We're going to talk about whether you're taking it early or waiting. We're going to talk about that. But Mike, do you want to do a Social Security intro?
Yes, I do. Let's get a couple things straight right now. No matter what you're hearing on TV or the radio or what someone's trying to give you some propaganda on, Social Security is strong. Social Security will be around. It's not going anywhere, okay? So plan, if someone says it's not going to be there, it's wrong. I mean, just look at, if you'll leave that screen up, Jeff.
Yep.
The income in 2020 was 1.118 trillion, okay? Expenditures are 1.107. It's an increase in assets of 11 billion. The trust balance on 12/31 was 2.908 trillion. All that's saying, all those numbers, all that's saying is it's strong. And by the way, even if they need to change something, it's easy for them to collect more money that really doesn't hurt us as much. Okay, so let's get this before Jeff starts. Social Security is here, it will be here, and I'll tell you something else ahead of time. Their COLA, their cost of living adjustment is very attractive. Go ahead, Jeff.
This just shows the long-term benefits here. So the projections are, without reform, which they'll do some form of reform, benefits would fall to 80% by 2035. What would they do? They would increase the maximum earnings to 142,000, raise the normal retirement age, lower future benefits, which I don't think they'll do, or reduce the COLA. 1 and 2 would probably be the most.
Yeah.
Number 1 is probably the biggest target there.
That's easy to do. They're actually behind a little bit on that. Don't tell them, okay? But they're actually behind on that. So that's what they'll do. They'll just raise the limits of the dollars that are allowed to tax. Okay, Jim.
Okay. Let's just say, this is just some examples. If your monthly benefit's $2,000 today, and you lived 10 years, you would have taken out $276,000. If you live 20 years, $600,000. In 30 years, you've taken out over $1 million. So the point is, you probably have a much higher Social Security. I know that everyone on this call has higher incomes. So as you can see, just even a $2,000 benefit, that person would have taken out over $1 million out of the plan. So it's a big decision. A lot of people think Social Security, it's not that big of a deal. It is. You can actually get a pretty high amount if it's particularly if you design the distribution correctly. Mike had talked about the cost of inflation. The average inflation on Social Security is 2%. So if it's $2,000 today, 10 years from now, $2,400. In 20 years from now, $2,900. And in 30 years, your benefit would have grown to $3,600. So as you can see, pretty big increases on the inflation adjustment.
Yeah.
So how much can I expect to receive? It's a function of 35 years of your highest earning years. So they calculate this AIME. It's a pretty intricate formula. And then that becomes what's called your PIA, your primary insurance amount, which is at your FRA, your full retirement age. You get your PIA, which is your primary insurance amount, which is based on 35 years of income. All right. So a lot of people think it's only 5 or 10 years, but it's actually 35 years. So in order to max out of Social Security, you would have had to hit that Social Security cap for 35 years in order to max out. And that's the formula. If any of you are having trouble sleeping at night, I can email this over to you.
You don't want to mess around with that one.
And this one will put you to bed real quick. Okay. All right. So why shouldn't I claim early? Why should I wait? There's a lot of reasons why. If you claim early, your benefits will be reduced. That's a big reason. And if you delay, every year after your full retirement age, you go up by 8%, and it stops going up by 8% at age 70. So when should I apply for benefits? Well, that depends. If you're unhealthy, you probably want to take it early, right? Because the average break even is around 17, 18 years. If it's not looking so good from you for a health perspective, you probably want to start getting paid. If you're going to live a nice long life and you're not sick at all, then probably the best bet financially is to wait till 70. If you need the income, I'm sure most people on these physicians on this call won't need the income immediately and don't need to take it early. So you would wait till 70 because you want to get that 8% step up. Also, if it's a spousal situation, you always want to get one really high one because at death, the surviving spouse gets the higher number. So a lot of strategies you'll max out the higher earner to get that highest number at age 70. And then in the event of death, whoever the survivor is will continue on. The one will drop, the lower one will drop, but they'll maintain that higher payout level for the rest of their lives.
What Jeff is, if I may interrupt again, what Jeff is telling us is that if there's any possible way, and most of the people on this phone call won't have a problem, perhaps health, you want to not start to take the income until you're age 70 because of that boost that Jeff just said that you have on the years after you reach full retirement to age 70, the increase they're giving you is significant. And then that compounds upon compounding as you get the longer that you're on the plan. So please try to take it to age 70 before you take those dollars out. Good, Jeff.
Yep. Really the only time we see it is unless you're unhealthy. Financially, it always usually works to wait till 70. So my FRA, that's my full retirement age. I can take my Social Security without any reduction. It depends on the year you were born. 1960 and later, your full retirement age or your FRA is 67. And then there's a breakdown on if you're more than 55, your FRA would be 66 in 2 months. Okay, so there's a chart here that we can provide for you if you're interested. So what happens if I take it early? If my full retirement age is 66 and I go out at age 62, then there's a 25% reduction in my PIA, my primary insurance amount. So if my 35 years calculation for my PIA, well, let's say it was $2,000 at age 66, and I took it at 62, that would be reduced by 25%. If my full retirement age was 67 and I took it at 62, there'd be a 30% reduction. All right, so that's a big deal because it's a pretty hefty hit if you go out early. That's why we're saying wait till 70, because if you wait till 70 and your FRA is 66, you get 132%. So that's 25% reduction versus a 32% increase. You get over a 50% higher payout by waiting. And if your full retirement age is 67, then you would get a 30% reduction versus waiting, a 24% increase. That's a 54% change by waiting. So it's a big deal, big number. So how do I know what my Social Security benefit is going to be? We strongly recommend to go to one of these, to go to the website, check it out, register. And once you get set up, you can check all of your numbers. It's very important that you check all of your work history on the Social Security website. They make a ton of mistakes.
Yeah, they do. Yeah.
Yeah. So and especially if you've had 2 incomes in 1 year, let's say you had another side business or something else like that. A lot of times they miss both incomes. So that's a common mistake that we see. Remember, those are big numbers. They all get added in. This shows, let's see, my screen's in the way here. Okay. More income later. So the benefit at age 70, if I had claimed it earlier at 62, my benefit at age 70, if this was a $2,000 PIA, it would have been $2,400. If I waited till my, I'm sorry, if I took it at my full retirement age, $3,500, and if I claimed at 70, $4,300. So that's a big difference there on waiting. As you can see, if my primary insurance amount was $3,500, that'd be 67 I would claim. If I took it early, it'd be $2,400 versus $4,300 if I waited until age 70. So that's a big difference, real big difference.
Right. And as time goes on, the important thing when you're taking money during retirement is as you get older, you want to feel more secure that those dollars are there. And if you're using and you're waiting till age 70 to take that money and that coal is compounding like that, you just feel better. I mean, that's just real life with clients. They feel better knowing they've got that guaranteed income coming in. That's another subjective reason to do that. Okay, Jeff.
Okay. Is my Social Security going to be taxable? Okay, well, it will be it's going to be taxable most likely. If you take it early, there's an income test. All right. So if you take your Social Security, let's say it's 62, you can't make more than like $18,900, or you have to pay more in taxes. It makes 0 cents. So if you're gonna take it early, you can't work or make more than $18,000. Okay. If once you're past your full retirement age, you can work and it's not a big deal. There's no penalty. Okay. Now you're going to have to pay tax on the money. The cap here is married filing jointly, combined income, and they add in half of your Social Security. Anything over $44,000, you're going to be paying 85% of your Social Security will be taxable. All right. So if I would made $10,000 in Social Security, $8,500 would be taxable to me. It's not an 85% tax. It's just 85% of my payment gets added as ordinary income from my taxes. Okay. So it's your adjusted gross income plus half Social Security, and they even add back in municipal bond interest into the whole equation. So I would say 99.9% of the people on this call will be paying tax on 85% of their Social Security. What rate that is dependent upon your tax rate based on your marginal income. Okay, we're going to look at a couple strategies here. This is to protect the non-working spouse. So if John's PIA is $2,000 and Jane's PIA is $800, let's say they were the same age, Jane would get no less than the $1,000, half of the higher earner Social Security. All right, half. So the non-working spouse, for example, is entitled to half of the working spouses. Or if the one spouse was less than half, they would get half. You know, maybe they worked for some time, but they didn't have a higher enough that was more than half. The primary worker must have filed for the benefits, though. So in this scenario, let's say they were both 67, but the higher earning spouse wanted to wait till age 70. The lower the lower earning spouse wasn't more than 50%. So what they would do is he or she would start taking theirs, and they take it early. Start taking that, because once the higher earner files at age 70, they would automatically jump to half. All right, so let me review that. The lower earner is their half is their primary insurance amount is not more than 50%. Right. So let's say it's $3,000 and the lower earner is $800. Right. So 3,000 versus 800. They're going to get $1,500 when the higher earner gets theirs at 70, which is 3,000. So they would take their 800 until the higher earner files at age 70, and then they would jump to 1,500 because they get half. Okay. The higher earner has to file, though. That's the trick. All right. Did that make sense, Mike?
Yes, actually, the way you came back on that, Jeff, was good,
okay.
Because it's complicated at figuring that out. Thanks.
Yeah. Now, if the lower earner is more than 50%, they would just take their own and wait to their full retirement age and let the other one run up to 70, or they both wait till 70 and they both take advantage of that 8%, and it works out fine either way. We do offer a custom Social Security maximization as part of the plan. If anyone wants to do that, you can let us know. If you're widowed or divorced, the age at which the deceased spouse claimed the benefit plays a role in this. But let's say the easy way is, let's say you're both on Social Security and somebody dies, they get the higher of the two. Okay, so in this example, Joe and Julie are married. Joe's benefit was $2,800. Julie's was $1,500. Joe dies. Julie gets to $2,800. Okay, pretty simple there. If they hadn't been filing yet, it gets a little bit different. They would get that primary insurance amount if they hadn't started to claim it yet, and the person died. The widow can actually take it at 60 if they wanted to, but it's reduced. They can take it earlier, but it's reduced. In order to get the full decedent benefit, they would have to wait till their full retirement age. For divorces, you had to have been married 10 years, not remarried, and you can claim off of your ex-husband or wife's Social Security. If you're married to multiple people, each for 10 years, you can't claim all of them. You can only get the highest. Okay, and the other person doesn't know. So the ex does not know that you're claiming against them, but you are entitled to theirs as long as you've been married for 10 years and you are not remarried. You can claim the spousal benefit, which is half of the ex-spouse.
Jeff, will you please go over the divorce situations again? This happens a lot, okay? And it's a little complicated. If you would please do that again, I would appreciate it for everyone else.
So let's say I look at my own primary insurance amount and half of my ex's is higher. As long as I've been married to that person for at least 10 years and I'm not remarried, I can take half of theirs. So let's say their amount was $3,000. So I'm entitled, I'm entitled to $1,500. Let's say my primary insurance amount was only $500 a month. I could actually take half of theirs, the $1,500. They have no idea. But I can't be remarried, and I had to have been married for at least 10 years.
And the other spouse does not even know you're doing it.
They do not know you're doing it. No. Okay, I think that's everything on Social Security. Yeah, that's about it. All right, so we covered how it works, how it's calculated, the difference of taking it early versus waiting, If you take it early, you get a reduction. If you wait, it goes up by 8% a year. If you die in your spousal situation, the spouse gets the higher. If you were divorced and were married for 10 years and not remarried, you can get the divorce benefit. Most people just wait till 70. And if it's a situation where, if you look at it and there was a non-working spouse in the mix and theirs is less than half, then they take it early and then it jumps once the higher person files. That's really the key. But most of the time, it's better off just to wait till 70. Nice and easy.
Agreed, definitely.
All right, that's Social Security. All right, let me jump back here. Just bear with me one moment. We are going to be doing the distributions chapter, which is chapter 5. Okay. Now we did kind of jump past the 401ks and 403bs. So we'll just go over those. You've got traditional and Roth 401ks and 403bs. I'll shoot back there real quick, actually. There. Okay, you can do 19,500 into the traditional or Roth 401k or 403b. 401k is for profit organizations, 403b is for nonprofit organizations, but they function just the same. Your contributions are always vested, which means you can always take your contributions out. Matching contributions, oftentimes there's a vesting schedule, which means you can't just take it out immediately. It might be after 7 years, you're fully vested, or each year you become a little bit more vested, right? The money goes into that plan. You can invest it in one of the out of the menu of choices. A lot of times people choose the target dates, which have become very popular. And what that means is, let's say target date 2030. That means usually I'm going to be age 65 in 2030. And the fund will actually start to move to a more defensive allocation as you start to approach your retirement. Okay, those are target dates, a very common investment in 401ks and 403bs. And at the end, when you retire, most people will roll the money into an IRA or leave it in the plan, and then they start to execute their distribution. In the Roth 401k, there's no RMD. In the traditional 401k, there is an RMD at age 72. Mike, did I miss anything on 401ks?
No, we're going to get to the point of distributions from there, and we'll cover the important thing, especially the mistakes made in distributions.
Okay, so let's talk about where we are now retired, or we switch jobs. What do we do with our 401k plans? Mike, you want to talk about that?
Well, the main thing is, I was just starting to say, when it comes to your retirement plans, there's going to be two major kinds. One's going to be your defined contribution plan. Your defined contribution plan is going to give you a lump sum of money. The other, and these are very good if your employers have them, is going to be a defined benefit pension, where you select the money at a given income that's guaranteed to you. But before Jeff gets started on this, I just want to warn again that when it comes to distributions from these plans, that mistakes are made very often that affect, especially the spouse, the second to die. And that is when they get to the point of saying, what choice do you want? And Jeff's going to cover all this, but there's going to be one that you choose only income for you, then only income for you and your spouse if you have a spouse, and other formulas. Don't rush when you choose the way you're going to do distributions. Make sure you have a professional helping you, because once you make those decisions, you can't change them, especially the spousal. Go ahead, Jeff.
Yep. So Mike just talked about pension plans. So before we get there, we'll talk about 401k plans and 403bs. So I'm changing jobs or I retire. What do I do with my 401k or 403b? Well, you could leave it there. That's one option. You're just limited to the menu of choices inside your 401k plan. Also, when you set up your automatic distribution, which is the phase where you're not in accumulation phase anymore, you're starting to generate income off of your investments, and you set up a systematic monthly distribution. A lot of times 401ks aren't set up to do that, so it's very cumbersome. You have to call every time you want to take a distribution. So what most people do is consolidate all their rollovers into an account, and then they set up a systematic distribution plan out of those accounts. And remember, at 72, if it's traditional, you have to start taking money out as well. So it makes sense just to move money into your own IRA. You can have multiple IRAs. You can invest it however you want in your IRAs. So a lot more flexible. It's a lot more flexible for the distribution component of your retirement.
Yes, those plans are not designed to spit out income. They're designed just to accumulate and collect money. When it comes to the point where you're going to start taking money out of your qualified plans, IRAs are designed to be so much easier to do, and it makes life so much easier on the person that's retired. Very good point, Jeff.
Yeah. So what you don't want to do when you roll your money over, you want to make sure you know where it's going to go first. That's called the custodian. So in this example, I've got $100,000 in my 401k. I want to roll it over to an IRA. I would first determine where I want the funds to go, what management firm I'm going to use, and then I would have the check made payable to that firm. I never want the check made payable to me, because if I do, they mandatorily withhold 20%. So in this example, you do a rollover 100, you get a check for 80, and now you've got 60 days to get that additional $20,000 in there, and it's a nightmare. So you don't want to do that. You want to make sure you have the check made payable to the custodian and not yourself. And that's a very big mistake that a lot of people make. So don't do that. Contact a professional and get it done, and that will avoid that issue. Now, once the money's in the IRA, you can move it back and forth between IRAs. That's easy. And that world is a lot more flexible than once you get it out of the 401k. I'm just going to skip this part here. All right. Now we're going to get to the part where Mike had talked about the pensions. This is a very big decision you got to make. What are my choices?
There they are, right there.
Yeah, and they're irrevocable. Once you choose your payment distribution strategy, you can't change it. So a single life will be the highest amount, but it goes away if you die. So the worst case scenario is you choose a single life and you die a week later. All that money is gone. Your beneficiary gets nothing. That's not a good deal. Joint 100, if you die, your survivor gets 100%. Joint 50% survivor. If you die, they get half. And there's a myriad of survivor options. There's also what's called a period certain, which is it'll just pay out for 10 or 20 years. There's a life with period certain, which means it'll pay out for your whole life, but no less than 10 or 20 years. So in that example, I know if it pays out for 20 years, we're good. We've got enough other assets. Well, then I'll take out a life. So if I live a long life, great, it pays me. But if I die in 10 years, it'll pay out the residual 10 years. You got to be careful with that. If you got to be real careful if in a spousal situation, you're taking anything other than joint 100% survivor.
Yes, 100%.
You got to be real careful that you don't make the wrong choice there.
Yeah.
Okay? Now, some plans have a lump sum feature. And what that lump sum is they give you that what's called cumulative value and allow you to roll that money to an IRA. And in essence, you could build your same distribution strategy. A lot of times, maybe people don't want to take their pension income. They don't need it. They could roll it to an IRA and invest it however they want. Right? Those are your choices for pension distribution. If you're in a 401k, we're jumping back to 401ks real quick, and you're not happy with the investment selection in your 401k, then you have the ability to roll out while still working. They don't advertise this. This is something that's built into the plan. But let's say I've got $1 million in my 401k and I don't like the funds. You might be able to do an in-service where they might allow you to roll out a percentage to an IRA, invest it however you want, but you're still in the plan and you're still making your contributions.
And there's usually an age restriction. You have to be over a certain age for those type of disbursements, but they're good things to do many times.
Very good point, Mike. Usually 55 years old is the trigger age. Some are 55, some are 59 and a half. summer, whenever you retire. But that's a good point. If you want to take money out early, you can bypass. Remember, traditional accounts in Roth, there's a 10% penalty for taking the money before 59 and a half. There is a strategy out there called 72T. This is a strategy that if you really needed to get the money, you can do it. There's a formula, and as long as you take the money out for 5 years or 59 and a half, whichever is longer, you can create income off of your. These are in situations if somebody gets disabled or they're in a bad place and they need to get at some of this money, but they don't want to pay the 10% penalty, then 72T can work. We don't really see it done that often really at all.
No.
Yeah, not a common strategy, but we just put it out there just so you know that it is there just in case something happens. Now, RMDs, we know that that's going to happen, right, Mike? 72.
It's going to happen. They are very strict. If you forget that, there's a 100% penalty on that. So make sure that RMDs, by the way, stands for Required Minimum Distributions. And they're very strict about you taking them out and the amount.
Yeah. So at age 72, there's a formula. What you do is you take all of your prior year's ending balances in your IRAs. This is traditional. Roth does not apply. And 401ks. Add them all together. Let's say it's $1 million. I have 5 accounts with $200,000 each, adding up to $1 million. There's a formula. It's like 3.7 in the first year. So I have to take out $37,000. They don't care which account I take it from. It just has to come out. I could take it all from one. I could take it pro rata out of each. It doesn't really matter. They just want the money to come out. So if you don't do it, it's a 50% penalty plus ordinary income. So you don't want to make that mistake. Most people consolidate and have it done on cruise control. You can contact the firm and they'll just automatically send it out at the end of the year and you'll stay out of trouble.
Yeah, a lot of people like taking it in the beginning of December for some reason. It's like a little extra bonus they give themselves at the end of the year. And it's a very convenient way to remember not to miss it.
All right, we're going to jump to session 2. So we're going to be switching to the other book now. And we're going to mix things up a little bit. We're going to jump to, we're going to do the risk management part first, and then we're going to end with investments. We got about probably 10 minutes to go through the risk management, Mike, and then we'll jump into investments.
You want me to start with the disability?
Yeah. Yes, sir.
Yeah. Disability. The biggest asset that you have in your early years of being in practice, and we probably have a number of people, most of them in there, your early years of practice and your mid years of practice, the biggest asset that you have sitting there is your ability to earn income. Okay, as time goes on and you do your savings right, it becomes your other assets. But disability insurance is extremely important to physicians. Okay, and it happens all the time. Let's see. All I can say about that is you've worked all those years, 10,000 hours before you walk out the door to earn a penny. You become disabled and you're going to lose it. Okay, there's types of disability insurance. There's group disability insurance, group disability policies. They'll be offered through your practice or through the hospital. They're going to be lower cost, okay? But they won't have the better provisions to. One of the things you want to hear a lot as a physician, and probably all of you out there already have this, are individual non-cancelable disability policies with your specialty clause, which means it's an individual policy. You cannot be canceled. And you are covered in your specialty, not just for any job. If you can't do your specialty, you're considered totally disabled, okay? And it's non-cancelable, meaning they can't change the rates in the meantime, okay? Other things that you have to know about disability insurance, you know, the own occupation already mentioned. If you go and take your group at the practice, 2 things I want to tell you. As number one, they're going to give you about 60% of your income on the group. But the important thing, and remember this, with disability, the group, if you use the group at your practice, they're going to ask you if you want to pay for it or they want to pay for it. A lot of times the practices will pay for the group disability, but you don't want to do that. If you use the group disability from your practice, you want them to to bonus out to you the money to pay that premium. So therefore, the amount of the premium becomes taxable, okay? And since you're using after-tax dollars to pay for that, every cent that you get when you become disabled is tax-free. If you let the practice pay for it, it's all going to be taxable. So don't make that mistake, okay? There's something called waiting periods. You know, it's a period of time before they're going to actually pay you after you become disabled. Actually, the longer you extend it out, the cheaper it's going to be. You know, if you say, I want to be covered on the first day, the cost is going to be a lot more. 90 days with physicians works very well. That you have to be disabled 90 days. You take a waiting period of 90 days, and that will lower your cost dramatically. And the money starts then, and you should have your emergency reserve there anyway. Length, they usually cover you to age 65. And once you hit age 65, if you're still working full-time, they will allow you to extend it every year, usually to age 70. Okay, so that's how long it'll last. And once again, make sure that you pay the premiums yourself no matter what. The best, there's no question, the best is use individual non-cancelable, but if you max out on that, then throw the group in on top. Good, Jeff.
Talk about long-term care.
You want me to discuss that also?
Yeah, absolutely.
Okay. Here's, this is probably a little subjective. 80% of our clients are physicians. It's just not fair. The kids say it's not fair. It's just not fair to work hard all your life and getting older and not having in-kind long-term care coverage. It's just not, we do all these things to help other people. Long-term care coverage is needed, very needed. And a bottom line is with long-term care, what's going to happen, people with money, they don't go into facilities. People with money do everything they can to just stay at home and bring in people to service them. But long-term care, now, what the heck is long-term care, and what the heck do you have to do to go on claim? Long-term care means it's an amount that an insurance company is going to give to you to pay long-term care coverage bills. That's number one. That's what it does. So what do you have to do to go on claim? Well, there's 6 daily living activities. If you can't if you have 2 of the 6 living activities that you can't do, you go on claim automatically. Or if you have mental, you go on automatically. Okay, so what are they? Well, one's feeding yourself, dressing, using the restroom, moving around, and mental. And then, so that's what's covered. They're excellent to have. So what kind and how do I pay for these things? Well, there's 2 basic ways you can pay for long-term care insurance. One is, I know everybody on this call has disability insurance of some kind, and you're paying it annual or monthly or something like that. And you just have to pay it until you retire. You can do that in long-term care, but a far better way to buy long-term care, purchase long-term care, is to use a hybrid policy. I call this the rich get richer and the poor get poorer. And a hybrid policy, it's a combination of the insurance long-term care coverage and also an investment. It's what happens is you usually have to make a lump sum investment. In the lump sum investment, you give the insurance company X amount of dollars. Now that X amount of dollars that you give to the insurance company is going to probably go down 15, 20% in the beginning and take about 4.5 years to go back. And then the income is there for you when you become disabled. Your cash account is growing higher than what you put in there. Plus there's a death benefit because it's a hybrid. It's a cash value life insurance turned into a long-term care. That's an excellent way to do it. You get your money back and things like that. Very much needed, but you have to have the money to do it. Go ahead, Jeff.
Yeah, the big drawback, a lot of people, when they pay the long-term care premium as a traditional style, is that you pay into it, and then what happens if you don't need it? You don't get your money back. With the hybrid, you can get your money back and satisfy your long-term care need. And if you die, This is a cash-free death benefit. So multiple uses of $1 there. Great plan.
Yeah. And
Love
also the dollars that are accumulating, I don't know, I would imagine a lot of people on the school probably have permanent cash value life insurance. But another good thing about this hybrid for long-term care, the money's all asset protected and it's all liquid.
Yep. All right, life insurance. How do I determine what I need for life insurance? Well, what do I want to have happen in the event that I die? How much income do I want to replace for my surviving spouse and beneficiaries? Or how much do I want paid off? Do I want the kids' college education funded? Do I want the home paid off? Things like that. And that becomes your need assessment is how much do I need for insurance? And then what are the different types, Mike, that I can buy of coverage? You got the term and then whole life and permanent.
Life insurance, okay? Life insurance, the different types of life insurance. First, there's something called temporary term. You hear it called term life insurance. Term insurance means you're going to pay money to an insurance company, and if you die, they're going to pay your family or survivors a death benefit, and they will last for a temporary time, a term. You can get 1-year term, 10-year term, 20-year term, sometimes term to age 65, but they all end. Okay, CPAs hate term insurance, but you know what? If we've got a young couple that doesn't have any money and they've got some kids that need it, then they buy term. Less than 1% of term life is turned in for death benefit. It's a good answer for a short time period. That's term, okay? The other is called, generically, permanent insurance, whole life insurance, okay? That product that is out there, that has a death benefit, okay? But it also builds a cash accumulation fund, okay? And once again, as I say this all the time, but the money that grows inside those policies, that cash value is all liquid, is all growing tax deferred, and extremely important is it is all asset protected. And believe me, I have clients using those funds because of that. Permanent insurance, you can get a single pay, 10 pay, life to age 65, you put in more money, okay? You put in more money, but the money starts to grow. And basically, the first 4 or 5 years inside those whole life policies are ugly as sin when you see the money you're putting in compared to what your cash value is. And the reason for that is that insurance companies, by federal law, have to put reserves aside in the beginning because some people do die. Some people do become disabled. But if you can survive the 4 or 5 years, the growth is great. And it's a good vehicle to use, okay? That's a very short description. Permanent, term, and one last one as cash value. If you have more questions on that, let us know. Go ahead, Jeff.
Okay. A universal life, if you got universal life, it's interest rate sensitive. So if you do happen to get a universal life policy, you want to have what's called an in-force illustration run. To make sure that the policy isn't in jeopardy because interest rates are low. So universal life is interest rate sensitive. Variable life is invested in the stock market. Same deal. You may have used an assumed rate of return that you didn't get, even though the market's done really well. You want to have an in-force illustration run to make sure that this policy isn't going to what's called lapse at your current payment level that you're paying, that there's enough money in there to support it because your insurance costs increase every year. So not to get too heavy into this, but if you've got a universal life, interest rate sensitive, variable life, stock market sensitive, you need to monitor those policies on an annual basis and make sure they're still healthy. Because what you don't want to do is if you need the coverage and you're 80 years old, and more likely to die 80, 85 years old, and the policy lapses at that point, or you're going to dump a bunch of money into it. So you got to be cautious with those. Yes,
especially with the variable life, because you're investing. Okay, and you just see it happen a lot where the investments aren't doing as well as they thought they would do. If you're going to invest and take risk, use your regular investments. Use your stocks, your bonds, use that for that. Don't use your insurance, okay? Because there's too much of a chance for losing it. Go ahead, Jeff.
All right, well, that leads us to our last chapter, which is investments. So, Mike, you want to talk about how do I determine what investments are right for me, and what are what's called my objectives? What are objectives?
Okay, now, the objectives that you have, they're going to change all through your life. But what we're talking about tonight is retirement money. Okay, so there's different types of investments for different types. And if I'm stepping over to your territory, Jeff, just tell me. Okay.
I got no territory.
Okay. Okay. Because there's some investments that are made for growth. Okay. They're going to be stock funds. There are some that are made for income, because you're going to have a time in your life where you're going to want to take income from them. Okay. They can be growth and income funds or bonds or any version of that. Okay. It's what you want to do with your principal. Okay. If your money's in a qualified plan, we all know you have to watch the tax situation. Okay. If you hear a fund called growth and income, a growth and income fund is one that's designed to grow. It's going to be stocks in there, but it's going to be have a lot of stocks in there that are paying heavy duty dividends, which means they've been around for a while and they're spitting out income. So if you're looking for income, either an income fund or a growth and income fund could provide that for you. A balanced fund is a stock fund, but a lot of people don't realize that a balanced fund, 30% of it isn't even in stock. 30% of it will be in cash or treasuries or bonds. So it's a lot safer, okay? Different vehicles for different purposes. Go ahead, Jeff.
Yeah, so like Mike just addressed, there's all different types of investments out there. And really, how do I invest? What's my objective? When I'm in my accumulation phase, approaching retirement, I'm in growth investments. When you retire, there's a big dynamic shift there, which is I'm now in an income phase. So in that income phase is, all right, well, I've grown these assets. How do I start to generate income? And I need to shift my investments into an income distribution, okay? Dividends, interest. That would be a big objective change, right? So do I need my objectives to produce income? Am I trying to grow? That's really the first step in determining where am I going to invest my money? The next piece here is the time horizon, which is how long until I need the money. If I need income sooner or later, can I put the money in here and absorb some ups and downs because I'm not going to need to tap into this money for 10, 15 years. Time horizon plays a role. You always, when you're developing a portfolio, your current investments, where you are now, needs to be analyzed to make sure that they match your objectives, right? We've got a great tool, Morningstar Advisor Workstation. If anybody on this call wants a full portfolio analysis done to see where you are now, is my portfolio actually matching my objectives? Then we can do that for you. That's free of charge, of course. We're more than happy to do that for you. So you need to know where I am now and where I want to go, and then also tax situation. Am my investments tax efficient? Am I in my Roth account? I don't care about tax efficiency, but in my taxable account, I want to make sure that my funds are very tax efficient. There's not a lot of turnover, and I'm tax harvesting, and I'm trying to be tax neutral. So that plays a big role in the overall decision-making process of which investments are going to be right for me at which stage in life I am.
Correct. Another thing is that the longer your time horizon is, okay, that allows you to have perhaps have more risk. The longer your time horizon. Okay, if these are mostly younger doctors this evening, that means you can take more risk. The shorter your time horizon, you're going to probably be more conservative and concentrate on keeping that. They were excellent points, Jeff.
Thank you. All right, loanership versus ownership. Mike, you want to talk about loaning money?
Okay, yes. There's when it comes down to investments, there's basically, and this is very basic, okay? There's basically two ways to do it. Ownership means that you buy ownership in a company, okay? Loanership means that you're loaning money to someone and it's going to be less risk. For example, with loanership is everything from a savings account at a bank to a money market account, CDs, the money, you are loaning it. Bonds are a form of loaning money to a company. So the company owes you money and they pay you interest for the use of it. Now, if a company goes bankrupt, the first people to get paid are the bondholders. They all get paid first. So that's another reason there's a lot less risk in it. The ownership or stockholders, when a company declares bankrupt, they get paid last, okay? Bonds are going to be less on return, less risk. Stocks, ownership, give you more risk, but also a chance for possible higher return. But if there's a problem with the company, you get paid less. Go ahead, Jeff.
Okay.
You want to go into bond ratings and things like that, please?
Yeah. We're going to get there in a second.
Okay.
So loanership, what types of loanership are there? I give my money to the bank. That's loanership. That's a savings account. CDs, money markets, all forms of loanership. And these are going to be the least aggressive, very conservative. Money markets, obviously, also conservative. And then we have bonds. We give money to either, there's really three entities: a corporation, a municipality, or the government. Those are the three types of bonds that are out there. I give the money to one of those entities for a duration of time. Let's say it's a 10-year bond. I give the money to this entity. Let's say it's a corporation for 10 years. They pay me a coupon or interest for that period of time. If I want to sell my bond before that 10 years is up, I can sell it. There's a secondary market for bonds where they can buy and sell. The price I get is dependent upon if interest rates have gone up, then I'm going to get less than what I paid. If interest rates have gone down, I'm going to get more than what I paid, a premium. So there's an inverse relationship to where interest rates have gone. So interest rates are very low now. We would expect rates to go up at some point. That won't be good for bond prices. Now, if I hold my bond to maturity, that eliminates that price risk because I know I'm going to get my money back. If I put $100,000 into a corporate bond, I know if I hold it for 10 years, I'll get my money back. The interest rate only plays a role if I sell it before that 10 years is up. Now, there's ratings companies that monitor the likelihood that they're going to pay you back, right? So anything below BBB, there's Moody's and Standard & Poor's. Those are the two rating agencies. Anything below BBB is what's called junk bonds and non-investment grade. So if you're trying to have safety in your bond portfolio, you probably don't want to buy junk bonds. You want to buy AAA rated or AA or single A. Those are investment grade bonds. That means they're very highly rated. You're going to get a little bit less of an interest rate than you would on junk bonds, but the safety will be there. All right. So when you're analyzing your bonds, it's something called duration, which is, on my bonds, short term, long term, midterm, or long term. That's the first step. And then also the credit ratings, those play a role in everything. So the safest bond would be a short term AAA bond. That's going to be your most conservative, very highly rated and short term. Longer bonds are more volatile than shorter bonds because you've got a long time horizon. Interest rates are moving up and down, particularly right now. You would not want to buy a long-term bond. You want to be in the short end of the spectrum on the bonds. I covered that. I covered corporate, municipal. One thing about municipal bonds, very important. So when you look at your asset classes and your types of accounts that you have, you've got your retirement accounts, and then you have what's called non-qualified accounts. Those are your taxable accounts. Those would be your trust accounts. Those would be your joint tenants by the entirety accounts. And those would be your singly owned accounts. If you own municipal bonds, the interest is federally tax exempt. So if you're in a high tax bracket, which I'm assuming most of you are, in non-qualified money, it makes a lot of sense to have municipal bonds because the interest is federally tax exempt. Okay, so make sure that this goes back to that tax efficiency thing. Non-qualified accounts, munis, or municipal bonds, that's kind of a must inside those types of accounts. And then you got government bonds. Those are just as conservative as you can be, backed by the full faith and credit of the United States government. Mike, anything to add on bonds?
Just one thing. I want to jump back to equities for just a minute.
Well, we're going into equities. We're going into equities now.
No, just a comment I want to make.
Yeah.
On equities, you're going to get the stocks equal equity and bonds equal loans. That's the only thing to remember on those things. The important thing is one is safer than the other. They both provide protection hedge, not as much. Now we'll get into the basics. Good, Jeff.
Okay. All right. So stocks, we're getting into ownership. So I want to buy a share in a company. I'm now an owner of that company. What's the benefit? Well, hopefully the benefit's capital appreciation. If it's a company that is what's called a value company. Dividends. Dividends are a big deal. I get a nice dividend. I pay a less in tax on those dividends, and it's a nice, reliable income stream. So for retirees and people approaching retirement, dividend-paying stocks are very, very nice. And they also act as an inflation hedge as well. So there's definitely some perk to owning stocks, that's for sure. So if I buy stocks, how do I buy a stock? Well, I buy it in the secondary market. And usually these are listed on indexes, and I can buy a stock through the exchange. The indexes, we've got the S&P 500, we've got the Dow Jones. The S&P is 500 of the highest market capitalized stocks. So how do you calculate this market cap? You take the shares outstanding by the share price, and that's what's called market cap. You've got large cap, mid cap, and small cap. So the S&P is 500 of the biggest stocks. The Dow is 30. So when you're using what's called a benchmark, make sure to see if my portfolio is doing what it should be. Hopefully, I'm outpacing the benchmark. The most common used benchmark is the S&P 500. It's a good cross-section of the economy that you can benchmark your portfolio against. The Dow wouldn't be a good benchmark because it's only 30 stocks, so not a good, too narrow. And then you got NASDAQ, very tech-heavy. Those are the indexes, okay? That's how I monitor how the market's doing through the form of an index, right? So when you look at stocks by nature, there's really two types of stocks. And this growth versus value or income is kind of more of a art than a science to determine which category they fall into, but it's really growth stocks are companies that traditionally don't pay dividends. They're in sectors that are growing fairly rapidly. Their earnings are really, really high, but they don't pay dividends because they have to take all of that money and they have to put it back into research and development and staying ahead of the game. So like technology, biotechnology, all growth stocks, right? So going to be pretty aggressive, more aggressive than what's called value or income. Income stocks are stocks that have reliable income streams. They usually have a bunch of cash on hand, and they're paying, like Mike said, big fat dividends that we like. They're reliable. And remember, the stock dividend doesn't change based on the stock price. It's still the same amount. So it's a nice, reliable income stream. If the only way they're going to reduce the dividend is if they come out and say, we're reducing the dividends this year. And if you're buying good dividend paying stocks, they very, very rarely do that because that is not too well reflected on the stock price. And the stock price usually goes down. So income stocks in retirement, dividend yield, that's a big deal because if we can pick up 2, 3, 4% of yield off the stocks alone, we like that. Okay, so growth stocks, more volatile than income stocks. Growth stocks are really designed for when I'm in accumulation phase. When I switch into income phase, I'm going to have a very heavily weighted value or income-oriented portfolio. So when you look at investment style, that's the first tier when analyzing stocks. The second tier, which we briefly talked about a moment ago, was the market capitalization. Large cap, 10 billion, mid cap, 2 to 10 billion, and small cap, 2 billion and less. The takeaway here is small cap is the most aggressive, mid cap's a little bit less aggressive than small, and large cap is going to be the least aggressive. So when you look at a stock, what's the least aggressive? It would be a large cap income stock. You're going to be picking up some dividend yield there. It's in a more conservative, stable type of industry, and it's got a big company that's been around for a long time. The most aggressive would be a small cap growth. There, it's a small company in a rapidly changing environment where they don't have any earnings. They're reinvesting everything to R&D, staying ahead of the game, which you've got a lot of upside, but you've also got a lot of downside risk there as well.
Jeff, would you comment on a stock split, how stock split really isn't that great a thing to see happening, please?
Yeah, absolutely. So if a stock split, why do companies split? Well, this is just a psychological tool, really. If the stock price is very, very high, a lot of people get timid on investing in it because they say, oh man, I'm buying this one share. Well, so if the stock price is $1,000 a share, I mean, everyone's gonna be like, oh my God, I'm not paying $1,000 a share. Well, maybe they'll split. And when they split, it's now $500 a share, right? But all they do is double the amount of shares outstanding. So there's really no value there. It's purely just a tool to get people to invest at a lower price because they think there's a difference there, but they expand the amount of shares so the market cap stays the same. It just looks like it's more appealing at a lower price. So kind of just a trick.
Yeah. When you hear a stock split, it doesn't necessarily mean something's good.
Yeah.
What's going on?
intuitively they say, well, if the stock price ran up that high, there must be something good happening there. That may or may not be the case, honestly. So yeah, they're kind of tricking you there a little bit in some fashion. All right, so if I want to invest in stocks, how do I do it? What are the different types of products out there? Well, the first one is you can do it yourself. Mike, you want to comment on that?
Well, people with money don't do it themselves, okay? If you want to have a play account like that, there's nothing wrong with having a play account where you go in yourself, you do your own research, and open up your own account with a broker dealer. Actually, it can be fun, okay? But with your serious money, you don't want to do it yourself, okay? You don't want to have to monitor what's going on and everything. You're not going to have the extensive knowledge that other people are going to have. When it comes to your serious money, that's when you need professional help. The do-it-yourself, I think it is fun, but not with serious money. Yeah.
So you're going to use a professionally managed account. Okay. And the biggest type of professionally managed account is the mutual fund.
Yeah.
Yes. So mutual funds, there's usually a fund family, right? And you have active versus passive management. Active is a fund family where they actually have a portfolio manager, and passive is an index fund. Index funds are going to be less expensive. Active managers, because there's a manager on there, there's going to be a portfolio manager, going to be more expensive, but hopefully that manager outpaces the index. That's called alpha, or adding value to the portfolio. Mike, would you like to talk about mutual funds?
Yes. Mutual funds, there's over 9,000, by the way, mutual funds out there. Okay. So you need help with them also. But one of the things, two doctors Bierbauer and Brinson, no offense, but thank God they weren't MDs. They were professors up at Northwestern University. Their theory is that when you have an overall portfolio, you're looking at all your investments. When you look at that, the net return in your portfolio over 90%, it's actually 91.3% of your growth comes in that account, not because of when you bought a stock or a bond, not because of when you sold a stock or a bond, but only because you have allocation. Because people, maybe like us or others, we speak a good game like we actually know what's going to happen in the market, and we don't. The only thing we know is that asset allocation, if you have that proper, you're going to be fine. Okay? That is the key. A mutual fund gives you instant asset allocation. You put $1 in there and you'll buy 15 cents of this, 20 cents of that, these stocks, these bonds, instant asset allocation. That is the most important thing in your financial growth is asset allocation.
Yeah, mutual funds, back in the day when people started investing in the stock market, they would only buy individual stocks because there was no mutual fund. But in order to have a well-diversified portfolio, it takes a lot of money to buy 200, 300 stocks to have a properly diversified mix. So the mutual fund was invented to where one share of maybe $25, you now own a little fractional share of 25 or 50 or 130 different stocks. So it allows you to diversify with the purchase of one share. So that's a big deal, right? And this gave the average retail investor the ability to diversify and average in or buy on a systematic investment into mutual funds, and now they're diversified, right? So some funds, active funds, have portfolio managers. You want to make sure that the manager is good. And anytime you buy a fund, you're going to get a prospectus. Inside that prospectus is going to be the objectives of the fund, the fees, about the fund manager. A great resource if you're trying to research an individual fund. We talked about fund families. You got Fidelity, Vanguard, American funds, all these different big fund families out there. Inside each family usually has a specialty or a niche that they're really good at. So when you're developing a portfolio, you want to make sure you choose the right fund family for what your objectives are. A mutual fund, how does the pricing work on a mutual fund? Well, at the end of each day, the stock market closes, they take a look at each share price and they calculate what's called the net asset value. So when you purchase or buy a mutual fund, you don't know what the price you're going to get until after the market closes, because they have to calculate everything. So if I make a purchase or a sale, I'll find out at the end of the day what price I get, because it's based on all those stocks in the portfolio, what the closing price is, and that NAV is calculated, called net asset value. So, people don't day trade mutual funds because they can't. It's one price at the end of the day, and that's it. Okay. All right. So, what type of you're gonna say something, Mike?
I was just going to say, with a final thought on that, if you want to leave with something, just buy a low-cost established mutual fund with a great track record and well-diversified. That is a good basis for you. If you knew nothing else, to do that.
Absolutely.
Are you going to discuss portfolio analysis, Jeff?
Yeah.
And dollar cost averaging? In
a few minutes. Yep.
Okay.
We're going to wrap up with that. Okay. So stock funds. We covered small, mid, and large. We now know what that means, right? Large cap's 10 billion, mid's 2 to 10 billion, small cap is 2 billion and under, right? So then we also have growth and value. We just talked about that. So the first tier is it a growth fund or is it a value fund? And then what asset class is it? So it's really growth versus value, and then large, mid, and small. All stocks will fall into one of those categories. The next is the management style. What type of style is the fund? Is it an index fund? Index fund means no portfolio manager, and it's just an index. You could buy the S&P, you could buy the E fund, the international index, you could buy the Barclays bond aggregate, that's the bond index. That's how there's all these different indexes, okay? And there's no fee, it's a computer traded. Low fee, no portfolio manager. That's what I meant to say there. Now on the active side, you've got growth and income. That means they own some growth stocks and some income stocks. So kind of a very balanced strategy there. If I'm looking to kind of diversify, a growth and income fund kind of hits both categories. Fixed income is usually just bonds and preferred stocks where I'm picking up some interest. And then balanced, you got some stocks and some bonds, usually like a 60% stock, 40% bond portfolio, kind of a one-stop shop balanced fund if you're looking for like a moderate allocation. And then we already covered bonds. We've got corporate, government, municipal. So if I'm looking for a municipal bond fund, that's going to be federally tax exempt. A government bond fund, all government bonds inside there. And then on the corporate side, all corporate bonds here. So this goes back to, well, I want to buy bonds, but I don't have the ability to go and buy a bond on my own and build a bond portfolio. That's what you use mutual funds for. That solves that problem, and it diversifies. So with one share, you're owning a bunch of bonds or you're owning a bunch of stocks. Makes life very easy for you. All right, Mike, anything to add on mutual funds before we leave?
No, except as I started to say, make sure you just find a well-established, a fund that's been around. Most mutual funds are 2 to 5 years old, so look for the ones that have been around for a long time. They have the expertise, and make sure you get the low cost on them also.
Okay? That's a great point. When you're looking at, you're doing your research, if you're looking for the lifetime of the fund, you want to use the longest time history they got. So 10 years plus, hopefully the fund's been around. And you want that having a really strong return over the last 10 years of the lifetime of the fund. Some funds have been around 15 years. Ideally, the fund's been around 10 years and it's got a great track record. That's a good sign. The longest duration or the longest historical data that you have is better, right? If the fund's only been around for 2 or 3 years, that's not a really good track record yet. So when you're looking at funds, how long that's been around for a long time, low fee, you want it to be under 1% if possible, and a good strong track record. All right. So we had mutual funds, then the evolution progressed into ETFs. And what is an ETF? This is the same way to get diversification, low cost, instant diversification, but it trades like a stock. So I can get in and out of an ETF on a daily basis. And there's an ETF for everything. There's gold ETFs, oil ETFs, inverse ETFs. If the market goes down, you go up. There's literally an ETF for everything. So this is kind of piggybacked on the mutual fund world, but made it more cost efficient and quicker response time We don't recommend trying to get in and out of the market quickly anyways, but it does allow you to get out quickly, and it doesn't calculate the NAV like the mutual fund. The big difference here is if I put in a sell order, it operates just like a stock. It gets executed and I'm out. And, the pros are the efficiency of trading, and then also low cost diversification. All right. So now I can do it myself. I can buy individual stocks. Very complicated. Probably don't want to be doing that. You want to use a manager. I could buy mutual funds. That's one form of a manager. I could buy an ETF. That's another form of a manager. But who's going to choose all the mutual funds or ETFs for my portfolio? Well, then came the individually managed account, which is called a fee-based account. This is where the industry has gone, right? No more commissions, none more of that baloney. It's purely one set fee. It comes out quarterly, and you know what you're paying. And that fee covers the manager in all transactions. So if they're making 10 trades or 100 trades, it doesn't matter to you. It's one set fee. That's a big deal, because historically, if you were going to call from your advisor or you're doing whatever it is, it costs you money every time you buy and sell, right? And whose best interest is that in the back of your head? This eliminates all of that. This is one set fee. Whether they make a 1 trade, 10 trades, 100 trades, doesn't matter. It's purely one set fee, and that's a percentage of assets. So if the assets go up, everybody makes more money. If the assets go down, everybody makes less money. So it's kind of an incentive-based compensation structure for the money manager, which we like. There's no reason why an advisor should keep making more money if your account goes down, right? Everybody should be on the same playing field. So in the individually managed account space, they've got all mutual fund-based individually managed accounts, all stock individually managed accounts, all ETF individually managed accounts, or a mix of stocks, ETFs, and mutual funds, all in one individually managed account. So you choose the money manager first of the individually managed account, the fee-based account. And inside there, it could be, the most common is a mutual fund-based, fee-based account, where it's one set fee. You shouldn't be paying more than 1.5% annually on those portfolios. Ideally, you should be all in around 1.3, 1.2.
Yeah, that's more like it, yes.
Yeah, 1.2, 1.3 is a great fee. What's that cover? That covers the institution, all the expenses, and all transactions. All right, everything encompassed in that one set fee. All right, and like I said, there's a lot of models out there where you can just buy the model. And a lot of times they'll use index funds, but they'll help choose the indexes, and that's called an active passive strategy. You see that? That's very common. Or an active managed account, where it's a low fee, actively managed portfolio. The fee's heavily discounted because it's in a fee-based account. And then the fund expenses plus the manager is still under 1.3%, 1.2. Okay. Any questions on that? No, that's good. All right. All right. We're just going to talk about annuities for a second here. A lot of bad press on annuities. There's some good ones, some bad ones. The first type of annuity, when you look at annuities, is there's immediate annuities, which is I give the insurance company my money and they give me some form of a guaranteed income stream. The same choices is when we looked at the pension, single life, joint survivor, that's an immediate annuity. Intuitively and historically, people think that's what an annuity is. I give the insurance company my money and they give me an income stream, right?
It's like a private pension.
Yeah, like a private pension. But the real deal is most annuities aren't immediate annuities. They're what's called deferred annuities. And what's that mean? Well, I give the insurance company my money, but it's invested. It's creditor protected, it's tax deferred, and it has beneficiary designation, right, by nature. I can have the choice of choosing a fixed deferred or a variable deferred. A fixed deferred functions like a CD. It'd be a 1 year, 3 year, 5 year fixed duration. Variable deferred annuities are in the market. And I take the investment risk on. I have to choose the right asset allocation there. Now, this is if you annuitize, that's the immediate annuity. And the deferred side, the only real reason is to do a deferred annuity in our minds are the creditor protection for physicians. And they also have features on there that can help you protect the downside or give you a guaranteed income down the road. And those are called riders that go on top of those accounts. This is for the person.
You want to explain that downside protection, please?
Yeah. So currently what a lot of people are using are, well, I'm nervous about the market. We're at an all-time high. It's starting to get starting to see a lot of volatility. So what they'll do is, it might be a 3-year or a 6-year window. They'll protect up to a certain percentage. So the most common one out there is a 6-year deal. Let's say I had $1 million in there. They look at a 6-year window. At the end of 6 years, they might protect 10, 15, 20, 30% of the first amount of losses. So let's use the 25%. At the end of that 6-year period, they'll pick up the first $250,000 of losses. Anything more than that, you'll take the hit on that, right? But I'm okay with a 25% hedge. What they do is they cap you on the upside. It might be a 50, 60, 70% cap. But at this point in the market where we're at an all-time high, I'm more concerned about downside risk than I am about upside, because I've just had a huge run in the market. So this is where I want to stay in the market, but I'm a little bit nervous about where we are. So I want to stay in the game. I can put a little bit of a hedge on the downside to protect, but I still got a nice upside potential in the market. There's another type where it's an income rider, where when I'm not taking income, it'll grow at a certain interest rate. And then when I want to turn that income on, I can get a guaranteed income stream. But unlike the annuitization, like of an immediate annuity, I don't give up that money. That's the big deal on those contracts. I don't give up that control. So I could turn on my guaranteed income, but 2 years later, still walk with all my money. It gives me that flexibility as well. So there's really two types of riders: downside protection for growth, or an income rider for income protection down the road.
The downside protection is very important to have on one of those vehicles.
Yeah, ideally, when you're building a portfolio right now, what we're seeing a lot of the money flow is into like the 6-year window. You're invested in an index. You've got the downside protection. So you strip out your equity risk, you dump it in there, and then the exposed money is in a very conservative portfolio. So let's say it was $1 million. You might move 300 or 400 into one of these contracts to protect it, maybe 25% downside. And then the other money is in value stocks and in bonds, very conservative. So if the market crashes, you've got the 25% hedge, and the exposed money doesn't take that big of a hit because it's mostly fixed income. That's kind of the way that the real life applicability of those types of strategies.
Especially now.
Especially now.
Yeah.
Yep. All right, we're in the home stretch here. We're going to talk about risk and how to prevent some investment risk. We're going to jump back to the market. So what happens with market risk? Well, you felt some of it today. The market goes down. That's what happens. You know, the prices, supply, demand, the people are selling off, and you start to see market risk. That's a big risk. Business risk. Business risk is if the underlying stock in the business that they're in, they're not making the best widget anymore, we could have a problem. Poor earnings, they report negative earnings or drop in their earnings, stock price goes down. We don't like that. Interest rate risk. We're facing the yield pop today again. So it's very aggressive interest rate risk today. So you're seeing a lot of this stuff happen right now. There was a big spike in yield today. The market dropped. That was really what caused the drop. So you're seeing kind of all this stuff play a role currently. So interest rates going up plays a big role. Inflation, right, Mike? Inflation's playing a big role right now too. Inflation's a big one. You know, you're seeing a big rise in inflation right now. That's a big deal. So that's happening.
Jeff, I'd like to tell them one thing that we just did to give them an idea of how we feel about it. When we run retirement numbers, you know, we put an inflation rate on there up until now. Okay, up until now, over the past 28 years, inflation has averaged between 1.7 and 2.4%. So we would run, just so you know, we would run our inflation rate at 3%, which is 30% higher. We always are more conservative in our outlooks. 6 weeks ago, we changed our inflation rate from 3% to 4%. That's 100 basis points. That's a huge move in that type of index. So we think that inflation is going to come. That's exactly what Jeff's talking about.
And with inflation, that impacts certain sectors of the market that you got to be concerned about, right? And particularly if you're a conservative investor and you're getting a yield of like 1 off or in your accounts and inflation's at 4 and you tax your investment, you're going backwards by about 3% a year if you're not invested correctly. So being too conservative in retirement, approaching retirement, can be a problem, especially if you get a 4% inflation and your interest is being taxed at ordinary income. I mean, you got to do almost 5 to break even. Then that's the reality that we're in right now. So it takes a lot of research to make sure that you're not in that situation.
Asset allocation,
liquidity risk, real estate, long-term CDs, things like that. You got to watch out for that. And opportunity risk. This is purely, this is why a lot of mutual funds keep like 4 to 5% in cash, because they want to take advantage of opportunities that may arise. And if they're fully invested, they can't invest in those opportunities. They have to sell off and buy, and that's a problem. So having some cash to take care of opportunities certainly helps as well. And then currency risk, obviously, that's all over the place right now. You get all kinds of stuff going on in the currency markets. So what are some strategies to avoid all this crazy risk? One strategy is dollar cost averaging. Mike, you want to talk about dollar cost averaging?
Yes. Dollar cost averaging is a great way to steal or save for ourselves. Dollar cost averaging means that you put the same amount in investing periodically. Now, when someone looks at their statement that they're getting on their investments, a non-professional will look at them, and the first thing that she or he is going to look at is how much money is in my account, okay? A professional will look at the same statement, and they're going to say, how many shares do I have? Because I'll say something I'm probably not allowed to say, but eventually the market does go back up. The important thing is how many shares you have, okay? If the market goes down, those dollars you're putting in there by dollar cost averaging, you're getting more shares as it goes down. So if you're putting in $100 a month and the price of the share is $50, you get 2. If it goes down to 25 or 10, and you say, these guys don't know what they're talking about, it might be down to 10, but you're getting 10 shares. Dollar cost averaging is a way to use the money that works in an up or down market. They're actually beautiful in down markets. Go ahead, Jeff.
Yep. Buying more shares at a lower price. It's a big deal.
Right.
Diversification, we talked about. We're going to talk about that here in a minute. When I show you this chart.
The famous chart, Jeff?
Famous chart. Yeah, asset allocation is key here. We go back to the beginning of the investment chapter. What are my objectives? What's my time horizon? How much risk am I willing to take on, right? There's really 5 different types of investor. You got conservative, moderate aggressive, and aggressive, okay? That risk profile determines how much equity versus fixed income, stock versus bond allocation you have. So like a moderate is probably like a 60-40. Okay, aggressive is going to be like a 90-10, 90% stock, 10% bonds. Conservative is probably going to be like 20% fixed income, 80%. So like to 20-80. Okay, opposite, right? So where you fall on that spectrum depends on a myriad of things, but really how you feel about ups and downs in the market. What's your heart tell you, right? And also what return you need to achieve in your portfolio to get to where you need to be. That's a big one too. So most times you do a risk comfort profile, you figure out where you fall and on that number, and then you build the asset allocation. All right, and when you build that asset allocation, usually you use an individually managed fee-based account to get there, right? Or maybe you do it yourself, either way, right? But we recommend using professionals. And that asset allocation is built, and you rebalance every year to make sure you maintain that asset allocation that you chose, right? And you don't buy on emotion. The only reason you change that asset allocation is due to lifestyle change. And the lifestyle change could be, I'm now not working anymore, but I need to produce income. I'm retired. Well, what do I do? Well, I need some dividends. I need some interest, right? That would be why you would change that asset allocation. That diversification of what keeps you out of trouble, It's what's called negative correlation. There's many assets in your portfolio that have nothing to do with each other. So you're always in one asset class or the other, which we're going to show you right now.
Jeff, if I can interrupt, Jeff made a very important statement when he said you never make a decision on asset allocation or what stock or bond you're buying from emotion. Never let emotion get involved. A way to prevent that is to be more systematic and do an annual review of your investments a year and objectively look and say, well, has my risk tolerance changed? But do it on an annual review. Never do it in emotion. Go ahead, Jeff.
Absolutely. Here's what a lot of people do, and this is what you don't want to get caught up in, right? They chase the market. They listen, they're at a cocktail party and their neighbors tell them how great they did in emerging markets, for example. Oh, I bought this emerging market in 2012, it's up 18%. You buy it at the high in 2012, and then what happens in 2013? It's down 2. And then it's up in 24, it's up 2. No, it's down 2. Then it's down 14. Then it's up 11. Then it's up 37. Then it's down 14. Then it's up 18. You do not want to chase the market. You want a diversified portfolio that owns a little piece of all this, skewed towards your risk profile, but you've got something in all these categories for a diversified portfolio. That way, you let the market come to you and you don't chase the market. You have a good, low-cost, diversified strategy, professionally managed, and you hold the course and you don't sell on emotion or buy on emotion, and you stay the course, and you only change that allocation based on a lifestyle change, which is I'm not working anymore, or I'm changing jobs, whatever the case may be. You have to analyze it on an annual basis and keep yourself out of trouble. But you don't do it by trying to chase the market, because by the time you get there, you're going to be doing the old buy high, sell low, and then you're going to put yourself into a psychological trauma that you don't want to be into, and then you're chasing the market, and you don't want to do that. You want to be there and have a good diversified portfolio.
Take one more good look at this chart and see the way that those different asset classes move up and down year by year. And don't think emotionally. Just look at that.
Yeah.
Asset allocation.
Absolutely. That's the big one. It's all, and Mike talked about earlier, all your returns come from asset allocation, right? A diversified portfolio, diversification is key. And that's what, if anyone wants to read up on it, and Mike was talking about modern portfolio theory.
Right.
Those were the 2 Nobel Prize winners. They talked about the efficient frontier and getting the most amount of return for the amount of risk. That's called modern porportfolio theory. And that's really how you build a portfolio.
Doctors Bierbauer and Brinson.
Yes, sir. All right. We're going to leave off here with one last piece here. One second. Where is it? Yeah, here somewhere. Mike, we're going to go over the timeline. I mean, the plan here.
Right. That's what we're going to do now, correct?
Yes. Okay. Yes. And I opened it somewhere and I can't find it. Bear with me here for one moment. Okay, here we go.
So I thought the master technician there was a little stuck.
Mike, can you help me? All right, here we go. So what we're going to share with you right now is a sample plan. And this brings everything we talked about together. Now, we obviously, if you sat here for 4 hours with us, we want you to get the most out of the class. And you're entitled to get a full plan done. We've had an agreement with the Medical Association where it's free of charge as part of as being a member. So if you decide you want to do that, Elko will send you an email. If you want to go ahead and take advantage of that, you can. It's not going to be a big salesy deal here. We're not here to sell you anything. We're purely here to make sure you get all the stuff done that we talked about. And then that's due to our relationship with the HCMA. So this is just a sample, and you'll see real life how we bring everything together in one snapshot of in this plan that we have here now. Mike, do you want to add anything before we go into this?
The only thing I want to add is if there's one thing that you do, if you have not done it yet, you need to do a financial plan. The person you're working with, he or she, make sure that they do that, please. This is the most important thing of your financial growth and your asset accumulation and wealth management is an annual review financial plan. Go ahead, Jim.
Yeah, but very important that if you were, unfortunately, a lot of advisors, who do you work with out there? Are they planners? Are they investment managers? You really want somebody that's doing both. The plan is
CFP. That's one thing.
You want a certified financial planner, and we're not just saying that because we are certified financial planners. You really do want to work with a CFP. That's a level above from an educational perspective. All right, so let's just have a conversation about what the plan looks like, Mike. The first page, the asset summary.
Yeah, the first thing we do is we just look asset allocation wise. Underneath that pie chart is the allocation, but we first look to make sure that people aren't over balanced in certain allocations. And when we look at the asset allocation, that almost immediately tells us something about what their plan is before we even see the numbers. So we look at make sure that they're not overweighted in an improper area. And then under it, we list all of their assets to verify the allocation. So that's the first thing we look at.
Yeah. So this is really like, are they too heavily weighted in real estate?
Correct.
Or, are they holding too much cash? Not the specific sectors of the investment, but what types of assets are they owning? All right. That's a big thing.
Yeah. Then we do a net worth statement. In finance with CFP, CPAs, the two basic things that we have are a statement of net worth, which we're looking at right now. And that is just list everything that you have, everything that you owe, and what's left over. That's a snapshot of what you have. Okay? Statement of net worth. The next, emergency reserves. To us, that's the most important thing. Forget all the fancy Dan investments. If you don't have an emergency reserve, you're going to be in trouble.
Absolutely.
And then the cash flow statement, that's like watching a video of your cash flow. What's coming in, where's it going, what are your expenses, and what's left over.
So if you remember from the first week, we talked about what's the first step in developing the plan. The first step was a net worth statement. What do I got? What do I owe? And then the second piece is I've got money coming in, I've got money coming out. And then also we need to do a cash flow for when you retire, what that's going to look like.
Yeah, that's got to be separate.
That's got to be separate.
You're seeing the redundancy here because these are the most important things that you'll see in an analysis. Yeah, we do the tax analysis also, working with their CPAs. We look at their different risk things that they need, whether it's life insurance or disability insurance, things like that. We cover them.
We got disability, and then we've got long-term care, which is a big deal. If you've got some, is it enough? We talked about that tonight, actually, long-term care coverage.
Yeah. And then we start to look at retirement now. Okay. And what we do is we take the numbers that the client's given us and we analyze them, we place them, we give them rates of return. And the rates of return you're going to see are very conservative with us. We'll give them a 5% growth rate. I'm not allowed to say what I'm going to say right now, but the rates of return are much higher than the 5%. But we base on 5% because the last thing Jeff and I want is one of our clients to be sitting watching TV and CNN comes on and says the world's going to hell in a handbasket and they worry. Our clients are going to have a conservative. They're going to know where they're going to be. And this is a chart.
This is very, very important. I mean, this ties into everything that we talked about, right? When you do your cash flow worksheet, that first column that says 216, that's your income need, and that's going to go up by 3 or 4%. We're using 4% now. That's going to maintain your purchasing power.
Very important column.
That next column is how we determine the best Social Security strategy. Any rental income would go in there, Social Security, any part-time work or anything like that, that would go in there. You will go with the far right. That's your nest egg number. And that second column where it says growth and additions, that's that 4 or 5% return that we talked about. So the key here is that you need the money to last into your late 90s. We talked about longevity risk, inflation risk. This is how we tie it all into this one snapshot to make sure that you're saving enough money, you get to that critical mass number in your net retirement nest egg that will produce inflation-adjusted income all the way to age 100.
That far right column is so important because you need to watch that and make sure it doesn't go down and run out. You want it to stay level or continue to grow. And this is just what historical rates of inflation have been.
Yep.
Survivor needs at death.
Yeah, this just goes into, once again, if you die, what happens? You tell us you want X amount of dollars for X period of time, what you want paid off. We analyze it and tell you if you have enough insurance or not. And then we can have a conversation about what type.
If I can go back, you don't have to go back to this, Jeff,
yeah.
But just very quickly on that timeline, the retirement timeline, on that one, and these are clients of ours, that they were fine for retirement. But when it comes up where the people are short and they're not going to hit their goals to have that lifetime income, a whole other set of reports comes up showing exactly what rates of return you would need to hit that goal, what amounts you would have to put in, and vice versa. It solves the puzzle for you. Go ahead, Jeff.
Absolutely. I think that then the next page we don't have, it's on here, but it's the recommendations. So at this point we summarize everything and make sure you're on target, and then come up with recommendations to solve any issues that we see that you may have. We also do a full portfolio analysis for anyone who wants to move forward in a plan, which is we dissect all your assets. And the key here is we aggregate them all together into one snapshot to make sure that your overall portfolio and all your accounts together are actually aligned correctly, they're allocated correctly, and that they're meeting your objectives.
And just because you're looking at the needs versus your current plan and everything's 100%, that doesn't mean everybody's like that, to say the least.
No. If they did, we wouldn't have a job. Just a couple housekeeping things. I'm going to tell Elka. Debbie wanted to jump back on here. We're going to conclude now, but we are here as a resource for you. Anytime you have questions about anything at all, if you do want to get a plan done, Elka's going to send you an email. If you want any information that we had tonight, like the cash flow worksheet or any Social Security information, we can email that to you and get that out to you. So you can do your own some research and follow up on it. And if you have any questions at any time, you have our contact information. You can reach out to us, ask us any question about anything. That's part of our relationship with the HCMA. We're here to provide education, and that's what we're here to do. And anything else, Mike?
Yes, we do have clients all over the country, and we have contacts and professionals all over the country. So if you're moving or going somewhere, reach out to us and we'll put you in touch with someone or get the things answered for you. And we'll help you in any way that we can. And I hope you folks appreciate how good your medical society is. We deal with a lot of them. And I know I said this last week, but you have an excellent medical association.
Absolutely. Absolutely.
I want to thank you both, Mike and Jeff. Thank you so much for the informative webinar and for the time that you take to try to help our members, and I'm sure they appreciate it. So thank you kindly.
Very welcome. Very welcome. All right, everyone. Well, have a great evening. Thank you.
Adios.
Adios. Bye, guys.
Bye-bye.
Bye.